Good afternoon, ladies and gentlemen, and welcome to Wapic Insurance PLC Half-Year 2017 Investors and Analysts Conference call. My name is Bode Ojeniyi, Executive Director of Sales and Distribution, and I'm being joined today at this presentation by Mrs. Yinka Adekoya, Managing Director, Wapic Insurance PLC, Mr. Dayo Ojolu, Managing Director, Wapic Insurance Ghana Limited, Mr. Ronsimi Ogunleye, Managing Director, Wapic Life Assurance Limited, Mr. Olufemi Obaleke, Executive Director, Subsidiaries, Mr. Peter Ehime, Chief Risk Officer, Mr. Olushola Ojeniyi, the Chief Investment Officer, Mr. Olushe Itawo, the Chief Financial Officer, and Ms. Zina Giwamu, Head Strategy, IT and Investor Relations. For your information, the half-year results being presented at this session was published last week in the national dailies and also uploaded on our corporate website for your use. During this call, we will discuss our business outlook and might make forward-looking statements. These statements and/or comments are based on our expectations as of today. Actual events and results could differ materially due to a number of risks and uncertainties. Before we jump into the presentation proper, we'd like to make a few housekeeping announcements. We are streaming live, and as such, the presentation is shared on your desktop and laptop. At this time, we advise participation to be on listen-only mode. I would therefore request that you be kind to mute your microphones so that you can hear us clearly, and such that background noise does not interfere with the audio. At such a time as the presentation is concluded, we have left ample time in the agenda for questions. Instructions for participation in the Q&A will follow at that time. We will also take questions that come in via the chat feature on Webex. During the Q&A session, please limit yourselves to one question and possibly one follow-up question. We will attempt to moderate the question as seamlessly as possible. As a reminder, this conference is being recorded. Thank you very much, ladies and gentlemen. We'll now go into the presentation. The next slide speaks to the outline of this presentation. We'll be talking a bit about Wapic, the regulatory environment, the operating environment, and thereafter we'll present the financial overview and subsequently the future outlook. I'll be taking you through the first three segments of the presentation, while the Chief Financial Officer, Mr. Olushe Itawo, would take us through the financial overview. I'll come back thereafter to present the future outlook as we see it. Moving on to the next slide, we'll present a snapshot of the Wapic Group. Wapic Insurance PLC operates through three entities, namely Wapic Life Assurance Limited, Wapic Insurance Ghana Limited, and the holding company Wapic Insurance PLC. We also have one associated company, Coronation Merchant Bank Limited. In Nigeria, we operate through 6 regional offices based in Abuja, Benin, Enugu, Ibadan, Kano, and Port Harcourt. Total number of operational staff is 169. Total assets is about 29 billion naira. Total shareholders is in excess of 850,000. And we have 13.4 billion ordinary shares of 50 kobo each in issue. We are listed on the Nigerian Stock Exchange, and the company also has a GDR depository bank with the Bank of New York Mellon. We are rated by AM Best, and our current rating is C++ on financial strength and B+ on Asia credit rating, both with stable outlook. Our actuaries are Ernst & Young Actuarial Services, and we're supported on the technical side by leading reinsurers, Munich Re, African Re, Continental Re, Waika Re, Ghana Re, and Nigerian Reinsurance Corporation. Our auditors are currently PwC. On the next slide, we give a brief summary of the regulatory and the industry environment. The National Insurance Commission, NICOM, has made a commitment to tackle rate cutting on insurance premiums by operators in the industry and apply appropriate sanctions on perpetrators. The Commission noted that rate cutting has become injurious to the sector and becoming a thing of concern to the insurance public. Also within the period, the London Stock Exchange admitted Nigeria's first diaspora bond to commence trading on the main market. Proceeds from the 5-year 5.625% bond will be used to fund infrastructure projects in the country. The bond is the first from an African country that is registered with both the UK listing company, or UK listing authority, I beg your pardon, and the US Securities and Exchange Commission, and is targeted at retail investors. The National Pensions Commission issued a notice to all employers wishing to solicit for business from any federal government ministry, department, and agency of the requirement to provide proof of compliance with the provision of the Pensions Reform Act of 2014, PRA 2014. Only pension clearance certificates issued by PENCOM will serve as proof of compliance with this provision. Also within the period, the Central Bank of Nigeria, in partnership with the Nigeria Education Research and Development Council, NERDC, finalized plans to commence the training of teachers ahead of the inclusion of financial education in the curriculum of primary and secondary schools in the 2017-2018 session. This is in line with the CBN's commitment to the National Financial Inclusion Strategy. NICOM released a draft of the revised guidelines for microinsurance operations in Nigeria. The draft guidelines was released to insurers, reinsurance brokers, and other industry stakeholders for adoption. On the operating environment side, I'll be sticking to these under 4 headlines: FX rates, inflation, crude oil, and GDP growth. Within the period, GDP contracted by 0.52% year-on-year in Q1 2017, being the 5th consecutive contraction since Q1 2016. It is forecasted to grow by 0.50% year-on-year in Q2 2017. The uptick in the economy is expected to continue, considering the improvements in manufacturing output, increased oil production, as well as CBN's sustained supply of dollars to critical sectors of the economy. On the inflation side, headline inflation continued on downward trend to 16.10% in half-year 2017, representing a 2.4% year-on-year decrease from same period in 2016. This is the 5th consecutive decline since it peaked in Q4 2016 at 18.55%. On the exchange rate side, Naira appreciated to 367 Naira to the dollar at the parallel market, backed by CBN's intervention in the FX market. Although the slight decline in oil prices poses a threat to CBN's continuing intervention in the FX market, the CBN support has been sufficient to support market liquidity and needed an exchange rate convergence between the parallel market and the interbank rates. On the crude oil side, in Q2 2017, oil prices dipped to $47.92 per barrel. This is despite the agreement between OPEC and non-OPEC members to cut production. While oil prices initially stayed above $50 per barrel, rising U.S. shale oil production coupled with the falling oil demand has wiped out any gains from the production cuts. I'll now hand you over to Mr. Oluseyi Taiwo to take us through the financial highlights. Mr. Taiwo, thank you.
Good afternoon. I'll be taking us through the financial overview, looking at it from 4 areas: the financial highlights, the income statement review, statement of financial position review, and assets under management. The total income of the group grew by 18% at the end of half-year 2017, closing at 7.1 billion compared to 6 billion same period 2016. Our gross written premium grew by 31%, closing at 5.8 billion compared to 4.4 billion half-year 2016. Our net underwriting income also grew by 29% year-on-year, closing at 3 billion compared to 2.3 billion half year 2016. Total underwriting expense grew by 19%, closing at 2.4 billion compared to 2 billion half year 2016. We had a 103% increase in our underwriting profit, closing the period with 622 million compared to 306 we closed with half year 2016. We had a decline in our investment and other income of 31%, closing the period with 922 million compared to 1.3 billion same period 2016. A slight increase on our expense and provisions of 6%, closing at 2 billion compared to 1.9 billion same period 2016. We had a 41% increase on our profit before tax, closing the period with 519 million compared to 368 million same period 2016. Our OPEX ratio declined by 19%, closing by 35% half year 2017 compared to 44% half year 2016. Our net claims ratio dipped by 6%, closing at 59% compared to 62% we closed with same period 2016. Our financial assets grew by 35% when compared to full year 2016, closing at 10 billion. We also had a 66% increase in our reinsurance assets, closing at 2.6 billion compared to 1.5 billion we closed with at the end of the financial year 2016. Total assets grew by 11%, closing at 28.6% compared to 25.9% full year 2016. Our shareholders' funds grew by 3%, closing at 17.1 billion at the end of the period June 2017 compared to full year where we closed at 16.5 billion. Next slide looks at the income statement review. We grew our GWP by 31% to 5.9 billion at the end of June 2017, up from 4.5 billion achieved in the same corresponding period in 2016. Our insurance expense increased by 32% to 1.8 billion as at half year 2017 from 1.3 billion recorded in half year 2016. This was as a result of the increase in our facultative insurance that we had to go into to be able to balance our exposure on specific risks, particularly in our oil and gas and general accidents portfolio. The group has continued to benefit from the growth in GWP by doubling its underwriting performance for the period, closing at 622 million for the period ended June 30, 2017, representing a 103% improvement from the prior period's position of 306. As a result of the implementation of our transformation strategies, we have ensured that we continue to optimize our costs. As a result, the 6% growth in our operating expenses, which is well within our improvement plans for the period. PBT continued in the same positive state with a 45% improvement from the corresponding period's position to close at 519 million compared to 368 million half year 2016. Looking at our product performance, our general accident product has continued to remain the top performer within the period, contributing 26% to the premium of the group. This is closely followed by our oil and gas portfolio, contributing 23%. Motor and life equally achieved good performance, contributing 18% and 19% to the product portfolio respectively. Driven by the sales performance in our general accident portfolio and our oil and gas portfolio, these two products continue to remain the most profitable products within the period, recording 45% and 38% contribution to the group underwriting profit respectively. Marine recorded the highest underwriting profit margin ratio of 37% within the period, followed by our general accident, recording an underwriting profit margin of 18%. Looking at our group expenses, the increase in our group's gross claims payout experience for the period was largely as a result of the 21% growth in our net claims expense, closing at 1.3 billion, compared to 1.6 billion we finished with at the end of the period. Notwithstanding the foregoing, the growth in our net premium income has cushioned the effect on our net claims ratio for the period, which as a result dropped our net claims ratio to 59% for the period 30th June 2017 from 62% we experienced the corresponding period in 2016. Our underwriting expense increased by 15% for the period compared to 2016 numbers, mainly driven by the better improvement in our top-line performance. The group continued to drive its improved efficiency in ensuring that the underwriting expenses are well within manageable positions. Owing largely to the large growth in the net premium income for the period, our underwriting expense ratio dropped by 21% from the period for what we closed with half year 2016 to 19% for the period ended 2017. Looking at our operating expenses, we had a nominal growth in our operating expense of 6% for the period to close at 2 billion as at end of June 2017 compared to 1.9 billion same period 2016. This is largely due to the drivers as we continue to invest in people, upgrade our technology solution for improved business process optimization, and also to ensure that we deliver seamless operational services to our customers. This resulted in a reduction in our OPEX ratio by 17%, closing at 75% compared to 89% we closed with half year 2016. Our insurance expense increased by 32% year on year, mainly as a result of the experienced growth in our gross written premium, and we would continue to ensure that the reinsurance optimization that the group has embarked upon would focus on achieving the desired results. The group's total revenue grew by 18% year on year to close at 7.1 billion at the end of half year 2017 compared to 6 billion we closed with same period 2016. The business groups that shows the highest contribution to the total income continues to be our large corporate business, contributing 49% of the total income generated by the group, followed by our financial institution business unit contributing 24%. Our Ghana subsidiary contributed 9% to the total group's GWP. Owing to the increase experienced in our underwriting income for the period, the group's underwriting profits went up by 103%, closing at 622 million, compared to 368 million experienced same period 2016. This had led to the underwriting profit margin ratio of 11%, a 57% increase from the corresponding period in 2016. The group recorded a PBT of 519 million at the end of the period, a 41% year-on-year growth compared to same period 2016, largely due to the strong returns from our underwriting performance and also our investments our investments. Our return on assets and return on equity remain positive, and we expect an upward trend from the 2% on return on assets and 2.3% we experienced on our return on equity for the period. Going on to the review of the statement of financial position. Cash and cash equivalents fell by 72% against full year 2016, primarily due to the portfolio realignment to take advantage of high-yielding assets. Our financial assets grew by 35%, reflecting the switch from our cash and cash equivalents to benefit from the elevated yield in fixed income securities during the period. Reinsurance assets increased by 66% to 2.6 billion at the end of half year 2017 compared to 1.6 billion at the end of the full year 2016, driven by the growth in our insurance expense arising from the growth in our GWP and also as a result of the cyclical nature of the insurance business. Trade receivables which is made up of outstanding premiums on broker-related businesses written during the period, closed at 325 million, a 41% reduction from the same period from 2016 full year position. Investment property declined by 30% in line with the strategic divestment of the group to ensure that we diversify our portfolio to higher yielding assets. Insurance contract liabilities increased by 32% when compared to full year 2016, following the growth in our GWP for the period. We're going now to the assets under management, to the highlights of our financial position, looking at basic contents of the financial position. And then our earning assets total assets ratio went down slightly by 5% compared to full year position to 69% as at end of the half year 2017, mainly due to the increased investment in our fixed asset. The group grew its total assets position by 11%, closing at 29 billion as at end of half year 2017, compared to 26 billion we closed with full year 2016. Insurance and investment contract liabilities stood at 9.4 billion, representing a 29% growth from full year position of 7.3 billion. Total liabilities grew by 23% to 11 billion in the period under review against full year position. Key drivers include our insurance contract liabilities and also the income tax liabilities recorded within the period. The group shareholders fund grew by 3% compared to full year position of 16.5 billion, closing at 17 billion as at the end of the half year 2017. Moving on to our asset under management. Our asset under management experienced a decrease on the term deposits, largely impacted by claims payout within the period. We increased our unquoted equities by 211%, reflecting our managed fund allocation as we identify long-term opportunities. Also, our quoted equities grew by 49%, underpinning the fundamentals of the portfolio stock and also the general recovery we experience in the stock market. Marginal growth in the value of investment in associate is reflected of the group's share of profit in our Coronation Merchant Bank associate. The growth in the bonds at 115% is a reflection of the lock-in yield at the current level to improve our asset quality while we continue to match our assets and our liability in the portfolio. I will now hand over to Bode Ojeni to take the other parts of the presentation.
Thank you, Sheyi. Ladies and gentlemen, we now present our future outlook for the remaining half of the year. And I'll be speaking to these under 4 different headers: the financial, operational outlook, sales, and people. With focus on diversification distribution channels, we expect to continue the growth in our top line figures in line with our strategic forecasts. We continue to proactively drive for a solid solvency margin ahead of any expected regulatory change in capital adequacy rules. We trust to maintain a continuous focus on cost optimization in order to meet our strict target cost-to-income ratio. On the operational side, we have transformed our corporate website into a world-class e-business platform and customer experience touchpoints to enable sales and enhance customer engagement. We'll continue to enhance our underwriting processes through improved risk assessment and selection. We have also enhanced our core business and technology processes, a solid foundation to our anticipated customer experience and operational transformation. On the sales side, the recent launch of our innovative smart products is intended to deepen our retail insurance penetration, grow our customer base, and improve overall customer experience. We'll continue to grow our corporate business, especially in the oil and energy sector, leveraging the local content regulation. On the people side, we remain focused on driving a high-performance organization. The recruitment, engagement, development, and retention of staff remain a priority for us, balanced against cost efficiency. We are inculcating the behaviors, culture, and innovations associated with leading customer experience providers. Ladies and gentlemen, this brings us to the end of our presentation. We'll now open the floor for questions. Thank you. Once again, should you wish to ask a question, please unmute your phone or computer and speak. We'd like to ask that you indicate your name and the company you represent as you ask questions. Thank you very much.
Hello?
Please go ahead. Yeah, please go ahead.
Yes, this is Wapic from Coronation Capital. I have two related questions on the, I guess, the regulatory outlook. The first is, I noticed there was some commentary about NICOM cracking down on unsustainable price competition, rate cutting, and also the allusion to a new risk-based framework coming into play for the Nigerian market. It would be great to get some color on the timing for these two regulatory changes, and really when we can start to see both changes impacting the economics of the sector. Thank you.
Thank you, Mr. Fonu. I'll take the last question first, which is on the risk-based framework. Our expectation is that NICOM would begin the implementation of this within the second half of 2018 and early 2019. But as a company, we have proactively began the process in our own system by engaging leading consultants to walk us through the Solvency II and own risks and solvency assessment processes. And we should be ready by the time NICOM is set to commence this process. We expect that this will be bring a significant shift into the structure and the depth of the insurance industry as we go along. On the second part, which is the price competition, we expect that this will be an immediate thing as NICOM begins to look at correcting the impact this is currently having on the industry. But the actual time frame for implementation is left with the regulator. Thank you very much.
Thank you.
Ladies and gentlemen, the floor is open for any further question.
Good afternoon.
Good afternoon.
My name is Mayowa, a research analyst based in the UK, and I would like to ask a question about your AM Best rating. Your last rating was a downgrade. How do you intend to improve it this year?
Thank you very much.
Okay.
The key issues with respect to the AM Best downgrade are on three levels. One, the rising operating expense. Two, the weakening combined ratio. And three, the sovereign risk, which has to do with the Nigerian economy, the weakening position of the Nigerian economy. Our response to this is in two folds. One, looking at where we are in terms of our growth trajectory as an organization, some of the expenses we've had to incur over the last 2 years were necessary with respect to positioning the company for where we're headed. And we have continued to manage these costs down, and we expect that some of these costs will not be repeated. Part of the impact is what you can see in our improved overall operating expense ratio, which is trailing down, and the marginal increase in our OPEX. We expect that we'll further drive this down and expect an improved assessment by the time we're going in for the rating exercise later in the year.
Okay, thank you.
Thank you. Ladies and gentlemen, we'd like to take any further question.
Hello?
Hello.
Hello. This is Ahobi Kota, Coronation Capital. Can you hear me?
Yes, please. Please go ahead.
Oh, yeah. Just a follow-up question, just more on the investment outlook. I noticed the repositioning of the investment portfolio to lock in, the current attractive yields. And presumably there was an attempt to capture some of the positive performance of the Nigerian equity market in the first half. I'd be interested in, the outlook from an investment perspective for the second half in terms of the trends, the company sees for yields, interest rates. Do you anticipate inflation continuing to fall? What are your views, given the terrific first half performance of equities? Does Wapic expect a similar outperformance in the second half?
Thank you very much. I'll ask Mr. Sheka, the CFO, to take that question. Thank you.
Yeah, on the question of outlook of the equities and also investment portfolio, what we do in Wapic is, as much as possible, we continue to look at the market and also to be able to position ourselves to ensure that we take advantage of what the market is about right now. But on the outlook we expect that inflation will tend downwards towards as we go into the year. For the past 3 quarters, we've been seeing a downward trend in inflation, and considering all what the regulators, the CBN, are doing, and also what the federal government is doing, we expect that this will tend downwards. On the outlook, the impact of this is also going to be reflected in the economy. As the economy picks up, you'd expect that organizations and companies where we had chosen our investments continue to pick up in their performances as the year goes down. As the year goes down, pick up their performances, and you expect that there will be improved performance in these organizations as the year goes by, and you expect those companies also to have a situation where they will have improved performance. So we would continue to look at the market and also to position ourselves to ensure that the yields we continue to position our portfolio to ensure we get high performing yields in the portfolio. Thank you.
Thank you.
Yeah.
Any further questions, ladies and gentlemen?
One last question from Ahobi Kona at Coronation Capital. I noticed the company is making a lot of progress. You alluded to, I was reading about the website becoming more functional. Could you give an overview of the company's efforts in the digital or e-commerce space to achieve greater market penetration? Thank you.
Thank you very much. The company currently has a 5-year IT transformation strategy well mapped out, and one of that is the upscaling of core insurance application to make it more user-friendly and more composite. And a lot of things that are coming on stream is the e-commerce and e-commerce enabled website to drive this process. So what you begin to see in the IT space for Wapic Insurance is a customer-friendly, business-enabled platform that would give an enhanced and improved customer experience for our clients. We also expect to leverage on this to deepen our penetration into the retail space.
Thank you.
If there are no further questions, ladies and gentlemen, I would like to thank you for participating in this conference call today. We hope to have you on board again when we have the next session. Thank you very much, and God bless.